The first sign of trouble wasn't diplomatic or economic. One of the world's most vital rivers abruptly closed. Long ago, people realized the Strait of Hormuz was the world's energy path. This narrow strait carried massive amounts of crude oil and liquefied natural gas to refineries in Asia, Europe, and elsewhere daily. The strait was small but safe for decades, with Navy patrols and commercial traffic in restricted channels. Within days, that passageway's rhythm began to break down. Shipping monitoring and marine insurers reported commercial ships shifting course or delaying departures. Tankers that normally crossed the strait without pausing were now seeking security advice at nearby ports. Satellite surveillance showed groups of ships remaining in Gulf waters instead of crossing the narrow passage to the open sea. Military briefings from surrounding states reported drone attacks and missile threats on maritime routes and local energy assets. Once reliable tankers and cargo ships were now unpredictable. Every delay strained a global supply chain. The Strait of Hormuz holds 20% of the world's traded oil. Therefore, even a slight issue there can affect energy markets worldwide. London, Singapore, and New York traders immediately recalculated risk. Energy markets reacted quickly and clearly. Brent crude prices surged above $90 a barrel, the greatest weekly increase since the pandemic. Sizable pricing adjustments require a structural shock. This shock was more than a guess. The sudden discovery that a vital energy distribution channel was unstable. Oil traders switched from theoretical risk models to real-world supply disruption calculations. The Gulf region is becoming more perilous for commercial tankers as shipping insurers boosted premiums. Extra insurance costs alone raised transportation costs, which raised oil prices before a barrel reached its refinery. Meanwhile, governments in electricity-dependent areas began monitoring the situation. Middle Eastern crude oil powers Asian transit networks, factories, and power plants. When Gulf supplies stall even slightly, it can affect industrial supply systems thousands of kilometers away. Several import-dependent economies' energy ministries began assessing their fuel stocks and planning for a supply shortage. Pressure was evident in the Persian Gulf. Major oil companies in the area need constant export volumes to maintain production. Storage facilities fill swiftly with crude oil that can't leave the country when tanker traffic slows or ceases. Regional logistics analysts indicated export ports were starting to have this issue. Pumping oil from fields continued, but export port pipes were progressively filling storage tanks with little room. Those circumstances increase hazard. Oil fields cannot produce forever when storage is full and transportation is blocked. Shutting in production means operators must temporarily reduce production or close wells. Later restarting the wells may need time, technological upgrades, and costly maintenance. Shipping problems might become industrial issues, worsening global supply in the long run. Energy infrastructure in the region was also getting increasingly risky. In a battle when economic power may be as crucial as military might, refineries, export terminals, and storage facilities were priorities. A drone attack on Saudi Arabia's Ras Tanura export system's largest refinery plant exposed how fragile this infrastructure was. Even though defensive devices stopped incoming drones and damage was restricted, the facility stopped operations for safety reasons. A temporary stoppage at a refinery of that scale would have far-reaching implications. Ras Tanura is a major Gulf oil refinery and exporter. It connects Saudi oil production to global markets due to its proximity to the Persian Gulf. When operations there ceased, global markets knew that once safe infrastructure was suddenly vulnerable to violence. In response, energy dealers adjusted their pricing forecasts. Petroleum prices rose beyond concerns about tankers in the Strait of Hormuz. It revealed future issues for local refineries and export terminals. Every single production standstill or shipping delay tale made people assume the situation was more than a short-term shock. Gasoline-dependent industry felt the effects. Jet fuel prices were closely monitored by the aviation industry, since long-term rises could raise costs for all international routes. Shipping companies had to do the same math when bunker fuel and crude oil prices rose. Petrochemical-dependent manufacturers are considering how long price changes will affect their production plans. Financial markets suffered from the chaos. Rising oil prices prompted energy businesses' stock values to fluctuate as investors tried to predict whether they would increase profits or worsen global supply networks. Transportation, logistics, and airline stocks, which are vulnerable to gasoline prices, declined as analysts projected higher operating expenses. Central banks and economic decision-makers also watched. Energy prices influence inflation projections. They affect everything from gasoline prices to shipping costs. Long-term oil price increases can make monetary policy decisions difficult, especially in nations with moderate inflation tendencies. As the first shock subsided and individuals considered the risks, the situation became clear. There was more to the conflict than soldiers. Systemic failure occurred in modern economy infrastructure. The chain reaction included oil fields, refineries, shipping lanes, insurance markets, and banks. Visual explosions and drone interceptions were only half of the conflict. Under that layer was a more complicated network of pipelines, tanker routes, export terminals, and financial arrangements that move energy worldwide. Instabilities spread quickly across continents in that system. As energy markets settled and people began to rationalize what had happened, they focused on the political and strategic choices that had brought the crisis to this dangerous stage. The spike in oil prices and shipping route disruptions are the outcome of decades of geopolitical turmoil. The Persian Gulf situation is not the consequence of a single misunderstanding or military decision. They are the latest illustration of a long-term geopolitical battle over Iran's nuclear ambitions, the region's power balance, and the poor security framework that oversees one of the world's most energy-rich regions. Iran's nuclear program has long plagued international diplomacy and strategy. Western governments have repeatedly warned that Iran's uranium enrichment may speed up nuclear weapon construction. However, Tehran claims its nuclear activities are for civilian electricity and scientific research. Rounds of talks, sanctions, and limited treaties have tried to reconcile Iran's technological objectives with the world's appeals for openness and caution. The U.S. bombed Iranian targets as part of this ongoing confrontation. Officials claimed intelligence data suggested Iran's nuclear facilities and military capabilities in the region presented a growing threat. Policymakers argued that defense before an attack was necessary to stop a destabilizing Middle East strategic shift. Tehran considered the strikes a clear attack on its sovereignty. Iranian leaders demonstrated its ability to punish its foes through military action and strategic messaging. Iran attacked the bigger Persian Gulf oil network instead of striking back. This strategy comprised drone strikes, shipping route threats, and oil production facility attacks. People do this because of global energy dependence. Iran can affect choke points, but it cannot control all Gulf oil. Tehran stressed shipping lines and energy infrastructure to show that the escalation will not be restricted to military bases or isolated installations. This transformation turned a two-sided fight into a systemic tragedy. The Middle East energy system is extremely interwoven. Production fields, refineries, pipelines, and export terminals form a logistics network. When a component of the system becomes unstable, the rest quickly follows. Regional governments understood this fast. Saudi Arabia, the UAE, Kuwait, and Iraq depend on oil exports to maintain their economies and cash streams. These states' economies depend on oil exports for public services, infrastructure, and sovereign wealth investments. A long-term disruption would affect global energy markets and make it tougher for Gulf governments to build their economies. At the same time, these governments faced a difficult strategic option. Defense of vital infrastructure, including refineries, export terminals, pipelines, and shipping lanes, was crucial to their economy. However, a harsh response could worsen the situation and draw more fighters. Regional military planners improved their defenses while avoiding worsening the situation. Air defense systems were activated around energy plants. Shipping channels saw additional naval patrols. As countries monitored threats to critical infrastructure, regional partners collaborated on intelligence. However, these actions may only partially solve the issue. Due to energy dependence, the economy was vulnerable despite strong protections. A refinery or export terminal strike may temporarily remove hundreds of thousands of barrels per day. These issues at many sites could become a global supply concern. Secret diplomatic channels were open. Asia and Europe, with strong economic ties to the Gulf, warned everyone to be wary. They are concerned about the military conflict and how it might affect global trade and business. If Middle Eastern energy flows stopped for a lengthy time, fuel prices may rise worldwide, placing pressure on industry, transportation, and household energy costs. Meanwhile, Washington's political leaders had their own numbers. Military action against a perceived strategic threat inevitably affects home. Fuel price increases impose political pressure on the administration at home because voters react quickly to increasing gas and electricity expenses. If oil prices stay high, they could become a key topic in future political debates, especially since inflation is still a concern, according to economists. Iranian officials believed their actions would be perceived as retaliation and strength. Showing you can shift global energy routes is strategic. It shows that Iran is still powerful in the area despite sanctions, isolation, and military pressure. These simultaneous computations caused a multifaceted conflict. Military actions affected local security. Energy infrastructure and transportation routes strained people economically. Diplomatic channels tried to cool things down, but markets reacted to every story. As the crisis's political implications became obvious, it affected institutions outside the Middle East. Commodity exchanges, shipping insurers, financial regulators, and global energy dealers adjusted their policies to account for the disruption's duration. The fundamental concern for such organizations was no longer if there was a crisis, but how long the structural pressures would last. Insurance would be expensive if shipping routes were unclear. Continued infrastructural shutdowns could cause greater goods shortages. If production in the key Gulf exporters dropped considerably further, the global energy balance might change for months. As political leaders struggled to maintain strategic power, the world's economic institutions discreetly prepared for a disruption that may have far-reaching implications. Governments and military forces didn't react first. Financial and logistical networks for global energy trading did. Commodity exchanges, shipping insurers, and oil trading desks reassessed Persian Gulf business risks at an unprecedented pace. The Gulf usually transports massive amounts of oil via well-defined channels. When shipping and energy facilities were attacked, the math shifted almost immediately. Financial institutions utilize risk assessment algorithms to quickly respond to global events. Pricing models began to account for delayed shipments, damaged facilities, and lengthier route closures. Futures contracts tied to crude production rose swiftly, indicating the change. It was clear from these adjustments that the market was aware of a possible physical disruption to supply channels. First, shipping insurers had to make swift decisions. Tankers that pass through the Strait of Hormuz have well-planned insurance coverage that covers weather, technical, and security challenges. When drone strikes and ship threats began, insurers rethought such arrangements. Ships going through the area saw premiums rise swiftly as insurers calculated how much to charge for the new hazard. Tanker operators felt these insurance changes immediately. If security was needed, a trip that was affordable days earlier could cost a lot more. Some maritime companies delayed departing Gulf ports until they knew more about the risks. Some considered changing ship routes or delaying cargo pickup. Every delay disrupted crude oil flow to refineries worldwide. The Gulf was not the only logistical issue. Asian refining facilities depend on Middle Eastern shipments. When tanker traffic slows, refinery management must use reserves or reduce processing. A few days after the shipping issues, many Asian and Middle Eastern refineries sent force majeure letters. In business contracts, force majeure means something extraordinary has made it impossible to meet the contract's conditions. In energy markets, such claims are serious. They mean supply chains are so unstable that contract delivery timelines are unreliable. When refineries use force majeure, they know disruptions are real. These refinery operator statements demonstrated how unstable global energy logistics are. Modern supply chains require close collaboration between producers, shippers, refiners, and distributors. The problem spreads quickly when one link breaks in that chain. Late Gulf tankers mean refineries lack crude oil. Less refining affects gasoline, diesel, and aviation fuel supplies in distant markets. Countries that import energy began monitoring these incidents. India, Japan, and China use Middle Eastern crude oil to power their factories and transportation networks. They need energy imports to grow economically, so any long-term disruption is a major concern. Government agencies in these countries began discussing disaster planning, diversifying supply, and developing strategic reserves. Strategic petroleum reserves are for when global supply lines fail. Released crude can stabilize domestic markets, but reserves should not replace long-term supply flows. So, officials had to decide, use reserves early or hold them in case the problem worsened. India's energy planners considered buying more energy from non-Gulf sources. Japan, one of the world's largest purchasers of liquefied natural gas, monitored gas markets when prices fluctuated outside of crude oil. The Chinese government also monitored refineries and exports to ensure gasoline availability. These emergency plans went beyond energy ministries. Bank regulators and central banks were discussed. Energy price shocks directly affect inflation, which affects interest rates, currency stability, and economic growth expectations. Central banks would have to adjust their policies if oil prices stayed high. Meanwhile, commodity merchants process data from shipping monitors, refinery operators, and government officials. Satellite tracking showed tankers in the Gulf of Mexico instead of the Strait of Hormuz. Shipping experts reported that hundreds of ships changed their schedules due to security concerns. People thought the disturbance was becoming worse after each episode. Financial markets behaved similarly. Investors shifted money to energy companies that would benefit from rising oil prices and away from fuel-sensitive industries. Analysts monitored airlines, shipping companies, and transportation businesses to see how long-term energy price increases might affect revenues. All these institutions reported the same outcome. A little quarrel was soon becoming a global energy market disruption. All sides were pushing for contracts, logistics, and financial systems that enable global energy commerce. Insurance firms changed risk calculations. Refineries stopped honoring contracts. Governments prepared strategic reserves. Traders changed prices live. Every institution recognized that the Persian Gulf oil corridor was no longer stable. That transformation affected areas well beyond the war's inception. The complex global energy system links producers, transit routes, refining hubs, and financial markets on all continents. When instability affects a web core, the effects spread swiftly. By the time institutional responses were fully implemented, the disaster was obvious. The war went beyond military acts and political pronouncements. It was a structural shock that might transform global energy. As tanker traffic slowed and export terminals had problems transferring stored petroleum into global markets, the crisis's economic effects spread across the international banking system. Oil is more than a commodity. It powers contemporary transportation, manufacturing, agriculture, and logistics. When that resource flow becomes unstable, it affects more than energy. Slow production was one of the earliest symptoms of a deeper crisis. Gulf producers normally anticipate a continuous crude oil flow from wells to pipelines to export terminals and refineries. Slower shipments over the Strait of Hormuz upset that equilibrium. Oil that couldn't be loaded onto tankers leaving important export terminals quickly filled local storage facilities. Producers must make a tough decision when storage capacity is nearly filled. Without appropriate export capacity, oil production could overrun infrastructure, but suspending manufacturing would generate technological issues and economic losses. As the backlog grew, Gulf operators cut production. Production cuts were undertaken because crude oil had nowhere to go immediately, not because of long-term strategic policy. Manufacturing slowdowns quickly affected global pricing systems. Commodity dealers monitor supply data. When significant exporters curtail production, prices rise because markets expect supply to tighten. Above $90 a barrel was more than a short-term worry. It revealed that people knew the disturbance had changed crude availability. Many businesses are affected by rising oil prices. The transportation industry frequently suffers first. Daily operations require a lot of fuel for airlines, cargo carriers, and shipping fleets. Fuel costs rise when crude oil prices rise, forcing companies to adjust their operations. Because fuel is one of the main airline costs, aviation companies monitor jet fuel prices. Airlines worldwide might lose money from even little oil price increases. With oil prices climbing rapidly, some airlines prepared for higher operational costs that might raise ticket prices or change flight itineraries. The same went for shipping companies. Ocean freight uses crude oil bunker fuel. Rising energy prices can hurt long-distance commerce routes. Shipping companies considered whether specific routes or delivery schedules could be less profitable if fuel costs rose during the disruption. The industrial industry also considered the future. Many industrial processes require crude oil and natural gas petrochemical feedstocks. Plastics, fertilizers, synthetic materials, and other industrial products are made using these energy sources. High prices can raise the cost of creating many different things. These pressures are linked to inflation. Energy costs affect shipping, farming, and delivery. Economic experts say oil is a basic input that affects practically every sector of the global economy. Thus, rising energy costs could raise inflation even distant from the source. Major stock exchanges became more volatile, proving this might happen. Rapid energy availability fluctuations may make it tougher for investors to predict economic changes. As speculators changed their thoughts about fuel-dependent firms, Asian and European stock markets fluctuated. Analysis forecasted rising operational expenses, which put downward pressure on transportation and aviation industries. Energy companies sometimes gained more money in the short term when oil prices rose, causing market fluctuations. Instead of rising or falling, there was instability. Bond markets responded as investors reassessed inflation risks. Government bond yields are affected by changing expectations about price stability and central bank action. Central banks may be less likely to lower interest rates or tighten policy to slow inflation if oil costs remain high. Currency markets added to economic reaction. When oil prices rise sharply, it can strain the currencies of energy-importing nations. If import prices rise, people will desire more foreign money to buy crude oil, weakening domestic exchange rates. All of these markets realized that the crisis was now a structural economic issue, not just a geopolitical one. The modern global economy depends on energy flows between continents. Interrupting that flow produces instability in financial markets, company strategies, and government policies. Instead of calling it temporary disruption, analysts began calling it structural risk. The two concepts are very different. After immediate security concerns subside, temporary disruptions usually end quickly. However, structural hazards indicate deeper flaws in global supply systems. For years, the Strait of Hormuz was known as a weak area. Geographically narrow and strategically vital, it is necessary and fragile. Tensions in that corridor affect more than just the military. What began as strikes and counterstrikes was now straining global economic stability. Energy flows, industrial supply chains, financial markets, and government laws all addressed the same issue. This crisis has tested the systems that keep modern economies running. Even when the killing stops, energy interruptions persist, according to history. Restoring oil fields, refineries, and shipping ports takes time and coordination. After being destroyed or attacked, these facilities may take weeks or months to restore to full function. The 2026 Iran crisis showed how tightly global energy supplies are channeled into a few tiny passageways, notably as the Strait of Hormuz, which chokes almost a fifth of the world's oil and LNG. Concentration affects logistics and strategy vulnerability. Policymakers must now accept that a single regional crisis can affect global markets, inflation, and industry planning. Energy-dependent economies must consider how much they depend on a few producers and transit channels. They must weigh the economic benefits of concentration against the strategic risks of instability. Companies are also rethinking supply chains and investments. Multinational energy firms must decide whether to expand their output, add more storage, or invest in Red Sea pipelines or Arctic shipping channels. Refiners and commodities merchants are also considering hedging to avoid energy network volatility. However, countries are reassessing energy security and strategic reserves. Countries that import a lot are considering if their stocks are enough to manage long-term disruptions and whether partnering with other suppliers may provide a buffer. This math goes beyond theory. Since oil prices have grown to nearly $90 per barrel, flaws can swiftly lead to economic pressure on consumers, inflation, and fiscal policy. The bigger lesson is systemic. The world's economic architecture includes key geographic locations where energy, money, and goods circulate. When critical places are threatened, transportation, industry, and financial markets are affected worldwide. The ongoing 2026 Iran issue has highlighted how fragile those resilience points are. and how one modest escalation might strain the global system. It's unclear whether the Strait of Hormuz episode was a momentary disturbance or the start of a long-term geopolitical upheaval that might affect energy dependence, strategic planning, and global economic stability for years to come. This episode highlights how regional disputes can transcend beyond their borders, making it an essential Ultimora 24 study. It also demonstrates how fragile global energy, banking, and security infrastructures are, and forces governments and corporations to rethink global trade in the 21st century. Strategic questions. How can countries increase energy supplies without worsening geopolitical threats? New shipping routes or renewable energy investments may reduce this crisis's impact. Will regional conflict-prone societies continue to be structurally vulnerable to concentrated energy dependency?